There is a problem that most ICT and small money concepts thinking that they trade like banks and institutions because that's the way those concepts were advertised as. But they realize, and that's the harsh truth after some time, that they're still retails and they still trade patterns. In this video, I'll show you why you're failing as a smart money or ICT trader, some of these smart money traps, and how to fix all of this and return to profitability. So you started learning about ICT and smart money concepts, and you always had that idea that you are trading like banks and you're not being a retail no more, you're not using trend lines or indicators. But the reality is that you're still trading patterns. And what is going to happen at the beginning is that you're going to start. Now, this can be your confidence levels and this can be your learning curve. You're going to be starting with a lot of confidence, especially when you're backtesting, especially when you can see the chart and only look at the things that prove that you're right but ignore everything else. And that's what the mind does, right? It always try to look for the things that support the idea that you have on mind. So it's gonna start going up, and you have that confidence. When you start trading, you get here and you're just starting falling lower and lower. And what is the reason is that you realize that whatever you're learning is not exactly the same in the live market. You don't see it the same way. There are a lot of traps. It's not the same no more. This is the top of your confidence. This is where you started live trading, and it just goes lower, same as when you get into a drawdown and cannot get out of it. I know a lot of people getting into this and just the confidence is going lower and lower, especially after getting introduced to smart money concepts and ICT concepts. So that's the main goal of the video, is to show you why you're failing as a smart money concepts or ICT trader. So you're going to be starting with this banks, which you're thinking that you trade like them. You are being an institutional trader. In reality, they do not trade those patterns. They don't trade the supply and demand the same way you're looking at. They don't look at order block as a pattern or breaker block as a pattern. They also don't look at those wedges or, market structure, where we have a breakout structure here, market structure shift, demand zone, all of those things. They don't look at the market as patterns. And that's the problem that you're having. You are looking at patterns. You either realize it or not, but the truth is that order block is a pattern. You're looking at that as a pattern. Fair value gap is a 3-candle pattern. And that's what we're going to cover on the next slide. But you are still trading patterns and you're believing that you're trading like a bank. That's the total opposite. Let me start with this question, and I want you to stop the video at this point. When I ask the question, go in the comment and write your answer, and then you can see the answer yourself and see if you learned something. What do you see? We can see that price is going lower. We broke structure to the lower side, and at this point what we had is something very clear, right? We had a liquidity sweep and a market structure shift. Obviously we want to long here because we had that market structure shift where we are going lower and now we're starting to go higher. That's the obvious thing. And a lot of people would look maybe for 1 hour fair value gap here or this order block, trying to enter of it going higher. And that's what a lot of people are believing in. Now you see here with more annotations, what happened after is we are coming into this fair value gap, reacting of it, breaker structure. We have this fair value gap here. And what happened is this liquidity sweep and then that market structure shift you were seeing, that was nothing but a trap for you. Price was actually sweeping this liquidity level to grab some liquidity and continue in the same direction that is going lower. And that's a trap for people following blindly the 2022 mentorship model. They're looking for that sweep market structure shift. But in reality, that market structure shift where a lot of people were believing in, even though we have a body closure here, they were thinking that now it's time to go bullish. What happened is price actually reacting of this fair value gap here and pushing lower against what everyone is believing in. And what happened after is this breaker structure and then this test of the fair value gap. Now, if you realize what happened here, the same thing. We were coming lower, going up, and then lower, and then here we had a market structure shift. Maybe on the 1 hour is going to be more obvious. Remember, market structure shift does not require a body closure. We just need displacement here. I mean, for me, I'm not gonna be looking for a market structure shift here, but I know some people will. So you see here, we close above, and then we're starting going lower. Maybe on the 1 hour, that was a closure above, and the price was coming lower to test something here. A lot of people would enter from here, but in reality, what was that? A fake market structure shift in order to go lower. So that's how you're getting trapped. You see this fair value gap, it's to go lower and it's not to be disrespected. This is not a market structure shift. This is a fake market structure shift. In other words, that is a continuation liquidity sweep. The more you just focus on trading patterns, the more you will fail. The harsh truth that I know that a lot of people will not accept, but it is the reality. And at least for me, that's how I see it after 5 to 6 years of experience. All of those things here that I'm mentioning, all of those 6 things, they're all looked at as a pattern. And some people I know will not accept this, but that's the harsh reality and the harsh truth. Now, order block, for example, is looked at as, for example, let's say the last bearish candle before the bullish move, or the opposite, or we can say the last consecutive candles, for example. But it is still a pattern when we're just focusing on those candles with no context around it, why it happens, when it happens, and all of the other criteria to distinguish between the high probability one and the low probability one, and which one will work and which one will not work. Same for fair value gaps. We're only looking at it as a 3 candle pattern. Sweep, we're always looking at a high or low to be swept. Totally a pattern without thinking that which one should we look for and which one to avoid. The 2022 model, that's an obvious example and a very clear example of a pattern. That's all you're looking for is something that is like this. That's everything. And I see a lot of people in Twitter just advertising it as a pattern with no experience involved, with no context involved, and it's not going to work this way. Market structure shift, same thing. You're looking at this pattern here, identify a market structure shift, and you're not looking at where are we in the price action, what happened, what about the fundamentals, what about everything. You're just looking at a pattern. And same thing goes for breaker structure. Now, a quote that really changed my trading journey and changed something on me that I'll never go back. To succeed in the market, you must learn to think like everyone else and do the opposite. You see those last 3 words? This is how to find profitability. What is happening is, let's say 95% at least failing as traders, and we are doing the same as them. In order to be profitable, you need to do the opposite of those people if you wanted to make money on the market. So the way is, you need to know how everyone is looking at the market. You need to know how everyone is looking at order block, and then do the opposite. You need to learn. I mean, this one here, the 2022 model, if you can master how people look at it, so this way, this is how people look at it, you could do the opposite and make money off it. And I'll show you in the next slides how to do that. But all of those things, we're looking at them as patterns, when in reality, we should think more about them, involve the experience in order to know which one to take and which one not to. It's not fully mechanical. Anyone tell you that there is a mechanical trading plan, it's not gonna work. You need to have experience involved in any trading plan in order to make it profitable. When we look at how people look at the market structure and how they trade based on market structure, they're actually engineering liquidity instead of making money. And let me show you how. Now, the market structure is taught like this. This is what you see in YouTube videos, and the reality is totally the opposite. So you see, let's say a breaker structure here, we consider this now as a strong low. Price will not actually come to this, and this is your trading range. And if it comes lower, you enter here, it goes up, you take profit. You see another breaker structure here, but then price closes below the last low. What is this now? That's a market structure shift. It means that we are switching bearish. Or if you're looking at this again, this is just a pattern by itself. Now we have another breaker structure. This high should hold, this high should hold, and same thing here, this high should hold. I mean, you were also taught in smart money concepts that this is a trend line liquidity, and what's going to happen is take some of those highs in order to go lower. So why you're not following this and you're considering your market structure same as this? If you see here to the right side, we can see that the reality is sometimes we get a breaker structure and price respect the order flow here and respect the range, and then goes up and give another breaker structure. But in this case, it does not respect the price action leg here, but goes and takes the low. In this case, you think that's a market structure shift. What happened after is another, let's say, market structure shift here. But you'll say, you know what? This is just a liquidity sweep. Forget about this one. Let's look at another breaker structure here. And now you say, you know what? We are actually bullish. What happened after is another market structure shift here. And you'll say, oh, that's another liquidity sweep. But in reality, it's a real market structure shift. And then we go up, we respect the order flow. We have another breaker structure here. And you'll say, okay, that's the price action leg from here to here. That's a strong high and needs to be respected. and I'll be looking for an entry in this price action late. What happened after is price taken that high, and you will think that this is a market section shift now. We are going higher. What happened after is going lower. That's a reality of the market structure, and that's how inducement works. They induce you to enter on a specific point. You are being the liquidity, price goes to somewhere, you engineer liquidity again by the market inducing you, and then it goes into the other direction. That's the cycle of the market. That's the reality of the market structure, and that's the theory of the market structure, and that's just how the textbook looks like. This is the reality of it, and you should always look at the reality, because if you go and look at your chart now of any pair, you'll see that this is what actually happened, and it's not this one. The same trap in the market structure, we can see it in the fair value gap. I mean, a lot of ICT traders only look at fair value gap as what? As a pattern. They think any fair value gap created is to enter from. And that is just a stupid way to look at fair value gaps. Why? Because it's a 3-candle pattern, yes. And even sometimes I trade it as a 3-candle pattern, but I ask those questions where it happens. I mean, where are we in the price action? What is the context around this fair value gap? Does it make sense to enter of it or not? So that's the question of where. There's also the question of why. Why is this fair value gap created? What's the reason? Is this fair value gap created to offer a fair value, or is it only created to be filled and to be used as a drawn liquidity, or is it created to induce people to enter and it is being a manipulation fair value gap? All of those questions should be asked in order to read that fair value gap and answer that question if it is valid or not. Now the other question is when, what time of the day this fair value gap is created. And this makes a big difference. Also, how? So when this fair value gap is created, how do we enter from it? Do we enter from the beginning of the fair value gap from 50%? We expect this fair value gap to be disrespected and price goes to the order block. All those questions need to be answered in order not to fall into this fair value gap trap, because at those days we're just looking at fair value gap as a pattern instead of involving our experience to distinguish between the high probability and low probability one. Now, some of the ways we look at fair value gap, some of them are just used as drawn liquidity and they just need to be filled. For example, this imbalance just need to be filled, and I'm not looking for an entry of that fair value gap because I know it's going to be disrespected. Now, sometimes we might be wrong, but overall, based on statistics, we want to be right most of the time. Now, also, there is an inducement fair value gap, and this one is used to create liquidity. You see how we get a reaction of it, and a lot of people would enter here, is used to create liquidity here in order to keep pushing lower. But there is a real fair value gap that offer fair value. So this one is a fair value and used to enter off and establishes expansions. This is the one that you need to be trading and entering from. Now, those ones you can be trading the opposite side, for example. And this one, if you have a fair value gap here or another drawing liquidity like a low that is very significant, you can enter even here when price respected, wait maybe for the retest, and then goes to the other low. But mostly I wanted to focus on this one because this is the real fair value gap, and I do have a lot of videos about how to identify the real fair value gap. You can look them up. Another fair value gap trap is the multiple touches. I mean, this is one of the mistakes that I was falling into when I was introduced to ICT and smart money concepts. They were telling me that anytime price goes to a fair value gap and then react to it, they call it mitigation or they call it a test, but it means that price is now willing to go back to the fair value gap again. So when price comes here, I enter confident, stop loss below the low. What happened after is price coming again to that fair value gap, taking my stop loss. And at this point, I enter again. What happened after is what? Same thing, taking that low again. At this point, and I know that a lot of people, because I was feeling this, I know that a lot of people would be giving up at this point because you had 2 losing trades and you already give up on this fair value gap. This is what institutions do. It's to take you out and make you give up on a specific area or a specific zone, and then they go without you. This is what happens. So price goes one more time to that fair value gap, and when not anyone is believing in this fair value gap, that's the time where price will go up. But remember that any zone you have, when people give up on the zone, that's the time where price will actually give the expansions. So at this point in this video, I don't want you to think that I'm totally against patterns, but I'm against how people trade patterns. Those are the 4 steps in order to trade patterns to make money and not to be trapped and not to be used as liquidity. Make sure that you have a profitable pattern based on statistics. So you do the back testing, you know that over time, this pattern is actually working more than losing. So that's the first thing. Based on the statistics, you know that this one is working. And then you go and practice in order to have that skill of pattern recognition. So you want to become better at identifying and recognizing that pattern in the chart any time of the day. So you'll be able to recognize that pattern very quickly and easily. If it was a very complicated pattern, you'll not be able to recognize it, and you'll be maybe recognizing other patterns as yours when in reality it's not. Then what you need to do is gain experience on that pattern. So go deeply and think about your pattern, when it works most and when it doesn't, and you will gain experience. Sometimes you will just train your eyes on which one works most and which one is not, and over time, and that's what's going to be the last step here, you'll be able to distinguish between high and low probability. You'll be able to identify which one will work and which one will not. That's going to be, even if it's a mechanical pattern, for example, it has specific rules. But sometimes based on your experience, you'll know that this one will work and this one will not. And you'll be wrong sometimes. But we're talking about, overall based on 100 trades. Mostly you'll be right if you have that experience. Sometimes you'll have that mechanical checklist and it actually fits all of the checklist, but you're not believing in that setup. And you'll say, based on my experience, this one will not work, but then it might work and it's totally okay. But we're talking about, big number of trades. So that's the way. If you wanted to trade a specific pattern, this is what you do: 1, 2, and then 3 and 4. Those are the steps to master pattern trading. Now, when I say pattern, I mean fair value gaps, order blocks, breaker blocks, all of those things. The 2022 mentorship model, all of those things are pattern at the end. So this is how you master trading patterns. Now, instead of me going over everything and giving you everything on a plate, I want you to go to the chart and think about those topics yourself. Maybe leave me a comment if you wanted. If there is one of those that you could not figure out, just leave me a comment and I'll be happy to help. But think about the traps that you fall into based on those concepts. The liquidity sweep versus the liquidity run. How many times you think that is actually a liquidity sweep and price will, reverse from a specific high or low, but what happened after is a liquidity run, a breakout, for example. Now think also about order blocks as a pattern and how many times it fails you. Think about agent sessions, sweep versus continuation. Think about how many times you were looking at the agent session to be swept and then reverses, but what happened in reality is a clear breakout to the upside, where you keep looking for short source until you fail. Think also about fair value gap mitigation or test as an inducement. Think about that. Think also about breaker block as a head and shoulders pattern. Why, when people tell you that they're trading head and shoulder, you say, oh, this is a retail thing. But when you trade a breaker block, you say that's how the banks trade, for example, and institutions trade. If you have any question about those concepts, because I really want you to use your mind and think about it yourself, because that might open other doors for you to think about. But if you're still not able to understand any of those, leave me a comment and I'll be happy to help. That's it for the video. If you think that this video might help someone, then make sure to share it with others. And if this video helps you, then make sure to also leave a like and a comment, and I will see you in the next video.